Today we have with us Shashank Singh, Managing Partner at Apax Partners, a man who manages over 1 billion invested in India for the past 8 years. Shashank, thank you for joining us on the VCC TV. You've been always very bullish on India. So what really gives you that confidence?
I think overall, and this is really through cycles, our view is that it is a large economy, growing well. It's a large private equity market, and a patient, careful approach to investing will produce long-term returns.
Okay. But, going by the cycles, this year looks confident, but there have been years in the past, like last year, late last year, last to last year, which have not given that good returns. So,
well, it depends how you measure returns. I think it's a little bit early to judge how private equity deals done those years will turn out. In fact, I think 5 or 6 years from now, we will look back and think about 2012, 13, first half of 14 as really great private equity vintages. Why do I say that? Because it's when markets are tough, when other sources of capital are difficult to come by, when valuations are a little bit depressed. That's when we do deals that actually turn out to be good. Because if you fundamentally back good companies, the right thesis in that market, then the returns will come. I think conversely, if you go back to a lot of the deals that were done in 2006, 7, early part of 2008, which were in fact great markets, quote unquote great markets for private equity in India when the market size was huge, there was a lot of deal flow, there was a lot of excitement, the public markets were high. In hindsight, they've turned out to be poor private equity deals from a returns perspective. So often, our business, the private equity business, works opposite to the mood in the country or the mood in the economy or the level of the stock market. I don't think you can overplay it. It's not just a macro play. We are micro investors. We have to look at great companies in good markets and bad markets. Our experience, for example, with Apollo Hospitals was that even a deal done at the top of the market in 2007 in a great company with a great management team produced great returns. The best companies find ways to create value in all markets. But in general, investing when the environment from a valuation perspective, a public market perspective is a bit suppressed or depressed, should produce good private equity returns over the long term.
you've been quite a turnaround investor. Apollo Hospitals, iGate, Patni. So, which next company do you think has that potential?
I would not call us a turnaround investor. That has a different connotation. Indeed, all of the 4 investments we've done in India, none of them have been in a quote-unquote turnaround situation. They've all been with great companies, great management teams, the right market opportunity, we feel. What I think perhaps sets us apart in our investing approach has been the fact that we come at each deal with a very clear value creation plan in mind. What is our thesis? How will we deliver value? How do we partner with the management team and the promoter group in that particular company to then create that value? Apollo Hospitals was really around supporting a great management team, a great company in their next phase of growth, both in the hospital side, in the retail pharmacy side, and also helping them be a bit more front-footed with the public markets and investor relations. iGate was about M&A and really supporting iGate to go acquire a company 2.5 times its size and create value through that M&A. Global Logic has been about acquiring a company which is in a fast-growing, less penetrated segment of the broad outsourcing space, and really to drive value there both organically and inorganically. And Cholamandalam is very new, but again supporting a company that was primary capital, supporting a company to really grow its exposure in the NBFC space. So there's been a different thesis with each of these transactions. I'd say we are partners to each of the companies and the management teams and the shareholder groups, the promoter groups, in creating that value. That's how I would describe our approach to investing.
Okay, now that we hear about the new government has already come in, the reforms are either kicking in or have already, set in some of the sectors. How do you view the scenario now with the new government?
So our view really is that a turnaround in the economy, a macro turnaround, will take time. The slowdown took time to play through. People forget that as late as second half of 2010, first half of 2011, GDP growth in India was between 7.5 and 7.8%. So roughly to get from 7.5%, 8% down to 4.5% took 3 years. And I think the uptick or the turnaround, if you like, to get up from 4.5% to a sustainable 7 to 8% growth level will take time as well. We're 9 to 10 months into the new government and a new approach to reforms, regulatory simplification, etc. Our expectation is that before real tangible results are in evidence on the ground, will be a period of 12 to 18 months. There is no shortcut. So there will be a long lead time. Companies will start to put in place investment plans. They will get the regulatory approvals required for that. They will raise the financing required for that. All of that takes time. So we have a perspective that over the next 12 to 18 months, we should start to see more concrete results on the ground. And indeed, that is what we're picking up from all of those we talked to.
How do you see 2015 as a year from exit perspective?
So I think for those funds who have companies that are sort of getting ready to exit and are mature in the portfolio, our perspective is 2015 should be a good year. The last 2-3 years were really focused on secondaries. By that I mean one private equity fund selling to another, for the simple reason that public markets were shut. The level of strategic interest, given the very messy scenario we had around tax rules and so on, meant that a lot of strategic and trade buyers were sworn off the investing in India. So FDI buyers had been scared off. And so those weren't great years for those other exit routes. But secondaries, once PE fund selling to another, continued. What has changed in 2015, what has definitely changed, is that the public markets seem to be open. A lot of companies have filed for IPOs. A lot of companies have been able to access public markets with follow-on offerings. A lot of PE funds have chosen the public market route to exit, even secondary sell downs, as we've seen over the last 6 to 9 months, with the upturn in the public markets and greater interest from foreign investors. We are still not yet at a point when it comes to strategic interest or trade interest in acquiring companies. We're not yet at a point, I'd say, that the floodgates have opened there. But that too, I think, with the right regulatory changes and changes in tax law, should follow.
And what about the macroeconomic situation, like the decreasing oil prices? How do you think that is going to affect the dollar-rupee ratio and investment in India, basically?
Yeah, so that's obviously beneficial. It has the main mechanism, essentially, where it benefits India is by taking pressure off the fisc. And that will then, that's one route. The other route is really on core inflation in the economy. So what we're going to start to see is interest rates come down, and that will benefit large parts of the economy, whether it is financial services, where there's a direct benefit, whether it is any firm that has investing or capex plans, which is also where private equity comes in. So it's a tailwind, if you like, for the economy. I think the governor of the Reserve Bank said in a recent public statement that oil price at $50 is a sort of $50 billion gift to India. And he's right. Plus, I think you'll notice that the price of gasoline at the pump has not come down for consumers by half. So I think what the government is also doing is using this opportunity to slowly reduce prices, increase taxes and excise duties at the pump in order to fill the hole when it comes to the fiscal deficit, which I think will have positive impacts all around. So to summarize, it's a big boost for growth, both the impact it has on inflation as well as on the fiscal deficit.
Okay. You've, Shashank, always been very bullish and excited about healthcare and financial services sector. So are there any other sectors that excite you, probably maybe this year?
So we invest in 4 sectors, as you know: technology and telecom, healthcare, consumer and retail, and financial and business services. Our perspective is that, in fact, all 4 sectors benefit from a cyclical upturn that we're seeing. Indeed, the technology sector has continued to trade through this, and it's more linked essentially to the economies in developed markets, especially the US, where it's over-indexed. And the fact that the US economy has been as strong as it has over the last 18 to 24 months is a positive for the technology industry. The other industries, the other sectors in which we invest are more linked to domestic demand, so financial and business services, consumer and retail, and healthcare. And our view is that all sectors should benefit with the current macro cycle. Indeed, we're seeing deal flow in all of them. We're seeing attractive transaction opportunities in all of them.
Lastly, just want to understand, going by your deal pipeline this year in India, how much do you think Apax is looking at?
So that's always a hard question to answer. I get it in every interview. We do not have a dedicated India fund. We don't have a regional fund. We invest out of a single global fund. And out of that global fund, we don't make allocations of capital to any particular country or sector, which gives the funds the flexibility to invest wherever the best opportunities are globally in our sectors. And the same, frankly, holds true for India. It's very hard to predict how much money we will invest in a particular year in India. It's really deal dependent. However, if you were to go by the investment pace that we've had so far, we have been in India on the ground for the last 8 years. We've invested about $1 billion over those 8 years across 4 transactions. So our average check size is about $250 million per transaction. I would expect that pace to actually increase going forward, for the simple reason that, having been on the ground as long as we have, we're more familiar with the country, we have more experience, we've had some success, and so that builds confidence and builds the ability to do more deals. So average pace for us, I would say, is probably a deal a year, roughly, and it should be in that same region, so about $250 to $300 million a year.
Great, Shashank. Thank you so much for your insights.
My pleasure. Thank you for having me.